So guys, post ESOPs, next concept is stock appreciation rate, or shortly called as SAR. Now this instrument SAR, or stock appreciation rate, is almost similar to ESOPs with one small change. Now just like ESOPs, here also we'll have a grant date. Here also we'll have a vesting period. Here also vesting conditions will be there. Ultimately, when options are exercised, the company will see what is the market price of the share. On the day, let us say market price of the share is 500. Exercise price in the option is 200. It's not value of option, strike price, exercise price. What the company will do is, market price is 500. You have a right to buy the share at 200. So in case you exercise the option, you will get a benefit of 300. If 300 is also called as intrinsic value of the option. So simply, there is no exercise of option, means there is no issue of shares and all. Company directly will pay cash of 300. If it was ESOPs, what would have happened? If it was ESOPs, what would have happened? The company would have received 200 rupees and would have issued a share to him whose worth is 500 rupees. So effectively, employee perspectively, if you see, employee pays 200 to the company, get a share whose market value is 500. So employee benefit is how much? 300 there. Here also same benefit only. Only thing is the share is not exchanged, directly cash is given to you. It is just like call options settled by way of physical delivery at ESOPs. Call options settled by way of net cash settlement at stock appreciation. Do you understand, sir? The same stuff. Now, employee ki company will pay cash on a point, company knows from day one only. So first day only we know that in future we have to pay. Company has an obligation to pay cash. When we have an obligation to pay cash, that will not become a equity instrument at all. Become a proper liability. So normal entries, whatever you write, EC to SBP reserve place, like here you have to write EC to SBP liability. Instead of SBP reserve, every year you have to create a SBP liability. Next important. Watch this. First day, grant date, fair value of the option was 90 rupees. By the end of first year, fair value of the option became, let us say, 150 rupees. Second year ending, fair value of the option became 210. Third year ending, fair value of the option became, let us say, 300. Even though option ka fair value changes daily in the market, we are not supposed to update that in our calculations, because ESOPs is a equity instrument, and equity instrument there is no subsequent remeasurement. But this is not equity instrument. This stock appreciation rate, where the company has a cash obligation. Since it is not an equity instrument, you definitely have to remeasure on every balance sheet date. So when you apply your formula, your option expense one formula we quoted, no, number of employees into number of options per employee into, when you write here fair value of option, in ESOPs we always considered fair value of option on the grant date, but SAR it is not like that. At the end of each year, latest fair value, so you have to keep on remeasuring this into vesting period completed by total vesting period minus expenditure, anta same. ESOPs la this portion is untouchable. Here definitely you have to update it every balance sheet. Why should I update, sir? Sir, simple. If you do not update, what will happen? Think once. Whenever you want reason, no, go against it, do and see. You yourself will know the reason. If I don't update, what will happen? What is the fair value of option granted? 90. Just like ESOPs, if I do accounting, what will happen? You know, 30, 30, 30. By the end of third year, I will create SBP liability of 90. Tomorrow morning, that fellow exercises the option. When I saw market price and checked how much I have to pay, I had to pay 300. Now books how much is there? 90. But I have to pay him 300. SBP liability 90. To bank 300. 210 rupees I have to debit to P&L account of 4th year. When bloody services are received in year 1, 2, 3, why will I book a huge expenditure in 4th year? Matching concept followed. And throughout the 3 years, I know market share price is crazily increasing. The amount of cash what I am going to pay to the employee also will increase. Knowingly, why will I create a liability of 90? This is wrong. Equity la problem not there. There you will not pay cash. No. There is no problem. But here, there is a problem. That's why this is irrelevant for you. Branded fair value. Latest fair values for you have to. So, 2 changes. What are the 2 changes? Number 1, option expense calculation low, you have to take the latest fair value of the option. Number 1. Number 2, while recording entry, don't call it as SBP reserve, call it as SBP liability. And you know, SAR is very simple compared to ESOP. In what sense? If SARs are lapsed, even after getting vested, some stupid people will be there who will be showing attitude for taking SAR option also. SAR option you need not pay. Simply have to put hand like this. Company will pay you 300 rupees. But some people are egoistic, they don't put hand like this. They'll say, my hand is always on top. So that fellow did not exercise the SAR option. Will go to P&L account. Because nothing will go to retained earnings in entire SAR. Remember this. Any reversals, any increase in liability, everything will go only into PRL. Why? Because that fellow is an outsider. Insider means equity instrument holder. Whatever paper he is holding, that is not equity instrument. It is a liability paper. He is outsider. And financial liability, any adjustments cannot come to retained earnings. Everything should be routed via PRL. India is 109 we studied. Ade concept. So 102 also tells that SAR, nothing will enter into retained earnings. Everything should be routed via PRL. Expense recognition, expense remeasurement, SBP liability remeasurement, reversals, everything via PRL. ESOPs a dangerous case. Sometimes PRL we are going. Sometimes retained earnings, sometimes even during vesting period lapse, you are still booking, you are not reversing it, you are still booking expense. ESOPs only multiple cases are there. R is relatively very simple case. The question which came last attempt, before last attempt, where number of employees is hidden. They'll tell the entire story. They'll tell you each year how many employees left and all, how many employees options are vested ultimately. But they will not tell you how many employees are there in the company on the grant date. You have to do a reverse working for that. You have to consider all the employees who left, employees to whom options got vested. You add up everything, you will get the original number of employees who are sitting in your company on the grant date. From that you have to remove rate of exit and work out estimated number of employees and all. ESOP 12 years back, old CA final AS syllabus came. Last 7-8 years, India syllabus, RTP, MTP, study, nowhere it is there. Our material it is there. Means I passed at that Zamana. I know that's a good question. It's supposed to come. It came. Every number they doubled and asked. So some questions, no, sir, the good questions you have to prepare. That's why here a number of employees estimation and all notes why we have written is because some questions immediately may not be there, but eventually they will come because ICAI has got all those questions up their sleeve. They can ask anything anytime. Okay, just random question. Suppose you are an employee. This is a company. Company is asking, do you want ESOPs or you want SAR? Choice is with you. Whatever you ask, they'll give you that. Now, first day, they'll give you only one. Excise price, everything is same. Number of options, everything is same. Vesting period, every totally same. Market price of the share anyway same. No, underlying asset is only one share. ESOP, you can take shares. SAR, directly they'll pay you cash. Which one will you choose? Sir, it is a preference, sir. Some people may choose cash, some people may choose shares. No, sir. You cannot apply preferences. You have to take SAR only. Given a choice, you should take SAR only. Why? Listen. Market price of the share after vesting date, I am telling, options are vested 500. Exercise price is 100. If you take SAR option, company will pay you cash of 400 directly. Company pays you cash of 400 directly. If you take ESOPs, you only have to pay to the company an amount of 100 rupees, but company will give you a share whose market price is 500. What will employee do? Now what is this? A share worth 500, I'll sell off share in the market. If you sell off share in the market, effectively if you observe, I paid 100, on sale of share I got 500, effectively I got 400, right? Imagine sir, I am having 1000 employees. Each employee 1000 ESOPs I gave. All fellows exercise the options. Shares I gave to them. If all these buggers tomorrow enter into the market for selling the share, what will happen to my share price? It will crash, no? Market will crash. I am promoter of the company, sir, 80% shareholding. On one side I am trying to make you owner, you are trying to pull down my wealth. So ESOPs, what companies do is they put a lock-in restriction. They'll say that share you will get, but you can't sell them in the next 2 years. So ESOPs come with a restriction. SAR lo nobody can put a restriction on cash. So they'll have to pay you cash, you take cash. SAR, no SAR, but I want share. Buy outside, stupid. If you want share, buy outside. Anyway, you are prepared to pay how much? 100 rupees. Company gave you 400, 500. Go to market and buy share. Freely tradable share you will have. Whenever you want, you can dispose it off. ESOPs, if you touch shares, no, you cannot sell it immediately. A lock-in period will do. So given a choice, no fool will touch ESOP. People will take only SAR. The background, if you know, we have a small discussion on this next concept irrelevant. No general knowledge points at that much time we don't have. This is ESOPs with cash alternative. That means company spells out vesting conditions, everything they'll tell you, exercise price and all. Last they'll tell you that employee at the end of third year, if you ask cash, we'll pay you cash. If you want shares, we'll give you shares. That means this is an instrument where choice is there with the employee. He can choose to take shares or cash. It's not like you are making choice now. You will make choice at the end of vesting period. How was such a stupid question, sir? Why will he take shares? He will not take shares, he will take cash. Why? Reason, the same reason. True. So you know what companies will do? They are also smart, no? What they will do is, if you ask cash, the SAR options if you select towards the end, you will get 1000. ESOPs if you select, you will get 1200. If I put both of them at the same number, no sir, no stupid will select. If I have to make ESOP option also attractive, then ESOP's number will be, you understand? So the choice is between what? 1000 SARs you want, 1200 ESOPs. Now there is a choice, no, genuinely. If this also I put 1000 only, nobody will select ESOPs. Happily SAR accounting we have to do nicely, because anyway we know what will happen later on. If somebody wants share also, they will buy in the market. Correct, no sir? So companies, what they will do is, in number they will keep it differently. Now that number is different, some people may select cash, some people may select shares, depending on what is their personal choice. Now there is a complication for us in accounting. How will you account this? Okay, now the standard name is 102. Financial instruments is 109. But unfortunately we already covered financial instruments. Tell me sir, an employee after working for 3 years, if he asks cash, can our company say no? You have an obligation to pay cash. It is just like debenture, convertible or redeemable at the option of holder. In that case, a principal amount, did you consider it as financial liability? Likewise, here also, even though ESOP's option is there with the employee, if he asks cash, we have an obligation to pay cash. Tell me sir, this type of sum lo, CFI liability will be higher, CFI equity will be higher. Principal amount, the moment you put it in financial liability calculation, what will happen sir? Liability will be big, equity will be small. Here also same logic. predominantly contract is accounted like SAR. A little amount may be accounted like just like CFI. Now the question is how to split and all we have to say. Very easy, sir. Watch this. I'll take it. Step number 1, you will work out fair value of cash obligation on granted. First day, what is the fair value of this? How many SARs are you promising? 1000. What is the fair value of this option? Let us say it is 30. Step 2. Fair value of your ESOPs, equity obligation on granted. First day. How many options did we promise? 1200. Into value of this option. Ideally speaking, value of this option and this option both should be same. The reason, market price of the share is same only, no? Same share. Share ke market price also same. Exercise price also same. Which maturity period also same. When everything is same, option value also should be same. But it won't be same because first option restriction is not there. Second option restriction is there. Whenever you put restriction, no sir, value of asset will fall down. Value of asset will fall down. So, E option ka value will be slightly lower. Let me take it as 32. Please do the math, sir. 38,000. Tell me, in amount wise, which one is higher? Equity. 38,400 is higher. But company is having an obligation to pay cash. So predominantly this contract should be accounted like SAR. But amount wise, who is higher? So you know what our standard says? Standard says do accounting like this. Identify something called as equity component, which is equal to step 2 minus step 1 only if this is positive. What is step 2? 38,400 minus 36,000, which is 2,400. Sir, what if step 2 number is less than 36,000? In that equity component is 0. If they both are same, anyway it is 0. So step number 3 is something which is applicable to you only when step 2 is higher than step 1. Okay sir, what will you do with this equity component? Let's see. Step number 4, the guidance is given now. What is he saying is 1000 numbers in step number 1, whatever is there, that will be accounted like a SAR. Properly do SAR accounting. Forget about ESOPs. Sir, but ESOPs also is there? No, correct. Step number 3 lo 2,400 is there. Amount you will account as ESOPs over the next 3 years vesting period. Every year 800 expenditure you will book. That's it. 1,000 SAR separately you will do accounting. Normal, just like individual SAR accounting. So what will happen is, in each year, your accounting entries will be like this. Employee compensation expense account debit to SBP liability. Also SBP reserve. Like that in the first year, like that in the second year, like that in the third year. Every year, SAR accounting also is happening. ESOPs accounting is also happening, but ESOPs accounting is happening with a lower amount. SAR accounting is happening with a bigger amount. Moreover, since it is SAR, every year fair value of options you must remeasure and you have to continue. Okay, sir. Now, by the end of third year, in your balance sheet, you will have SBP liability also, SBP reserve also. I'm randomly writing some number. 1000 options ki. Here you are having 60,000 rupees. Here you are having 2,400 rupees. Now choice is with whom? Choice is with whom? Holder. Employee has a choice. Case 1. Entry you should tell me, okay? Employee selects cash. Tell me the entry. SBP liability already created for that purpose only, go and pay. The amount what you have to pay is intrinsic value. If that intrinsic value and 60,000 both are matching, no gain, no loss. But if it is more or less, gain or loss is possible, that will go into PRL. Because employees are outsiders here, not equity instrument holders. Okay, this is one entry. Then what will happen to your SBP reserve? SBP reserve is ultimately not required. We'll transfer this to retained earnings. Is it not similar to what we did in compound financial instruments? The same stuff, right? Next, case 2. Employee selects equity shares. If employee selects equity shares, what will you do? Good. What you will do is, SBP liability, whatever you are having, SBP liability also you have to transfer it to SBP reserve. Already SBP reserve, some amount also is there. This also getting added. Next, what you will do, SBP reserve you will cancel. From that to issue equity shares, and balancing figure you will put it into securities premium. If he is giving you any money, take that money also. And the excess price will be there, no? That one. This will be balancing figure. Nothing new, sir. Instruments, if you are clear, your closing parts will be very, very easy. But the entire ESOPs law, entire share-based payment chapter, where you should be careful is, ESOPs ka, when ESOPs are not vested ultimately, SBP reserve, where should it go? The retained earnings kit will go up, PRL kit will go up. Though I know that it is not vested, still I have to book expense in some cases. Like market condition failed, still I have to book expense. Options are cancelled, still I have to book expense. cases and all, you should be careful. Next, employee estimates. Even though you are standing at the end of first year, you should estimate the number of employees who are going to be there by the end of third year. That estimates and all, you should be careful. If you are done with that, ESOPs will never trouble. ESOPs is never a chapter which will be complicated and all. Okay, in this one, last case is there, but that last case is very, very low level for you. But still, my duty, your duty, so we'll fulfill it off. So there is parent company. There is subsidiary company. Employees are rendering services here, but ESOPs will be given by parent. Now what entries parent will write, what entries subsidiary will write? Simple, sir. Who received services? Always check this. Who received benefit? Service ka benefit. Who received subsidiary? Subsidiary only should book the employee compensation. Who has obligation to issue shares? Parent should only create SBP. See, lovers are separated. Till now, they were together. EC to SBP reserve. Now they are separated. One is in subsidiary books, one is in parent books. Don't worry, climax law they will get merged. Consolidation law, proper entry will come. EC to SBP reserve. But individually, this is the accounting what you have to do. Clear, sir? Now, for giving ESOPs to employees of subsidiary, if subsidiary company compensates some cash to parent, or it says that in future they will compensate, then if you are receiving money, you receive money bank. If they are agreeing to pay you, create a receivable. Suppose the amount is 1000. They are agreeing to pay, or they paid only 400. A remaining 600, I did a favor to them. Tell me, who is showing love on who? Parent on subsidiary. This will be adjusted to investment in shares of subsidiary. Similarly, here, if I pay 400, or if I recognize a payable of 400, then 600 I am enjoying a benefit from my parent company. This will be accounted as capital contribution from the parent. Right, sir? Same story, reverse you tell me. Employees are giving services to the parent, but ESOPs is given by subsidiary. Tell. It is just like dividend is declared by subsidiary to the parent. Subsidiary will debit the gap to retained earnings. Parent will credit that gap to dividend income. On this also questions are there. Small questions, but albeit they are there. Clear, sir? So guys, that is the end of our ESOP chapter.